If you own a home in California, your property value is about to take a hit you didn't see coming. 2.8 million policy non-renewals between 2020 and 2022. State Farm canceled 72,000 fire insurance policies in a single year. The FAIR Plan just imposed a $1 billion emergency assessment that's landing on your doorstep as a hidden surcharge. Think your homeowner's insurance is protecting you? Think again. This breakdown exposes how California's insurance market collapse is functioning as an invisible property tax that's destroying home equity across the state. Hit subscribe to Discover Cities for real estate analysis that protects your wealth before the market catches up. Before we break down who's fleeing and why this matters to your bank account, you need to understand what's driving this exodus. California operates under Proposition 103, passed in 1988, which requires insurance companies to get approval from the state insurance commissioner before raising rates. Sounds consumer-friendly on paper, the reality is more complicated. Insurance companies calculate risk using actuarial models that factor in wildfire probability, construction costs, and reinsurance expenses. When those costs spike, they need to adjust premiums to stay solvent. But in California, that adjustment requires navigating a bureaucratic approval process overseen by an elected official who faces voter pressure to keep rates low. Between 2017 and 2022, California had the largest gap in the nation between what insurers said they needed to charge and what regulators allowed them to charge. Now add climate-driven catastrophe into the mix. The 2017 and 2018 wildfire seasons alone caused $20 billion in underwriting losses for insurers operating in California. That's double what the entire industry had accumulated in profits in the state since 1991, wiped out in 2 years. When a carrier faces that kind of existential risk in a market where they can't price accordingly, they have one option: leave. But here's where it gets interesting. When major insurers pull out, they trigger a cascading failure that hits every homeowner in the state through higher premiums, forced reliance on the underfunded state backstop plan, and declining property values. The cost of this regulatory structure isn't being paid by insurance companies, it's being paid by you. Number 5, Allstate's complete statewide withdrawal. Allstate stopped accepting all new homeowner, condo, and commercial insurance policies across California in 2023, not just in fire-prone areas, statewide. This wasn't a reduction in coverage or a pullback from high-risk zones. This was a full stop. If you're buying a home in San Diego, Sacramento, or inland areas that have never seen a major wildfire, you can't get an Allstate policy. For buyers trying to close on a home, this cuts available options by a major carrier. Mortgage lenders require homeowners insurance before they'll fund a loan. When a top 10 insurer pulls out completely, buyers have fewer quotes to compare and higher risk of being forced into the FAIR Plan before they even move in. A home might be listed at $800,000, but if insurance quotes come back at $8,000 annually instead of the expected $2,000, that changes the buyer's debt-to-income ratio and kills the loan approval. The sale dies, the listing sits, the seller drops the price. Your home equity erodes without a single flame coming near your property. But here's the reality. Allstate didn't leave because of one bad year. They left because they ran the numbers on California's regulatory future and determined there was no path to profitability. When a company that size makes that calculation, it signals to every other insurer in the market that the risk-reward ratio is broken. But wait until you see what happens when multiple carriers exit simultaneously. Number 4, the coordinated retreat: Farmers, Liberty Mutual, Travelers, and American Family. These 4 carriers quietly reduced their exposure across California through a combination of policy non-renewals, restricted coverage areas, and halted new business in high-risk zones. Between 2022 and 2024, all 4 carriers made significant reductions to their California operations. When you add up their combined market share, you're looking at a massive chunk of California's insurance capacity vanishing. If you're a homeowner in Sonoma County, Napa Valley, or any of the areas that burned in the past decade, your renewal notice likely came back with a massive premium increase or a flat denial. The replacement option? The FAIR Plan, where you're paying $3,200 annually for coverage that used to cost $1,400 through a standard carrier. That's an $1,800 annually out of your pocket, or $150 per month, just for a little bit of peace of mind. Tell that to a household earning California's median income of $84,000 annually. That extra $1,800 represents more than 2% of pre-tax income just for insurance. Add in rising property taxes, higher mortgage rates for recent buyers, and general inflation, and you're looking at homeownership costs increasing by 20 to 30% annually while wages stagnate. But here's the kicker. When the top 10 insurers in a state all reduce coverage simultaneously, they're responding to the same structural incentives: a regulatory environment that won't let them price risk accurately, catastrophic losses that exceed their reserves, and reinsurance markets demanding 50 to 70% premium increases. California's market isn't just difficult, it's mathematically impossible to operate in profitably under current rules. And if you think that's bad, State Farm's numbers reveal something far worse. Number 3, State Farm's 72,000 policy cancellations. State Farm is the largest California homeowners insurance carrier. When they canceled 72,000 fire insurance policies in a single year, they sent a shockwave through the entire real estate market. 72,000 households that had coverage suddenly didn't. Let's do the math. If the average State Farm policy was $1,500 annually, and those 72,000 households now pay $3,200 through the FAIR plan, that's an extra $1,700 per household per year from State Farm's cancellations alone. Tell that to a family in the Santa Cruz Mountains who just watched their annual insurance bill jump from $1,400 to $3,500 overnight. That's $175 per month, or about 4 to 5% of median household income in California just for fire coverage. But here's the reality driving State Farm's decision. The company filed for a 20 to 30% rate increase with California regulators. The approval process dragged on for months. Meanwhile, the 2023 fire season approached, and State Farm's actuaries ran the numbers. Operating at artificially suppressed rates while facing exponentially growing risk wasn't sustainable. And here's what nobody's telling you. State Farm didn't cancel randomly. They targeted areas with the highest wildfire risk, which happen to be some of California's most desirable real estate markets: parts of the Sierra foothills, wine country, and foothill communities. These areas command premium prices specifically because of their location and natural beauty, but that same location makes them uninsurable at current regulated rates. When 72,000 policies disappear from the largest carrier in the state, other insurers see State Farm's exit and recalculate their own risk exposure. If the biggest player can't make the math work, why would smaller carriers stay? This is exactly why you need to stay ahead of these market shifts. If you haven't already, subscribe to Discover Cities so you're never caught off guard by these real estate earthquakes that destroy wealth overnight. But the real shock comes when you see the total scale of this exodus. Number 2, the 2.8 million policy non-renewals and the $1 billion FAIR plan bailout. Between 2020 and 2022, insurance companies issued 2.8 million policy non-renewals in California. That's 2.8 million existing policyholders who had coverage and then received letters saying their insurer was dropping them. If each of those 2.8 million households faced an average premium increase of $1,000 annually when forced to find new coverage, that's $2.8 billion in additional annual insurance costs being absorbed by California homeowners over a 2-year period. That's $2.8 billion that's not being invested, saved, or spent in the local economy. Break that down monthly, and we're talking about $230 million per month in additional insurance costs hitting California households. An extra $1,000 annually represents 1.2% of median household income just to maintain insurance. But here's where it gets worse. The California FAIR Plan is supposed to be the insurer of last resort. It's not a state agency. It's a pool funded by every licensed property insurer operating in California. When the FAIR Plan runs out of money, it assesses its member companies to cover the shortfall. Those companies then pass that cost directly to you. In 2024, the FAIR Plan imposed a $1 billion emergency assessment on its member insurers after catastrophic wildfire losses depleted its reserves. Major insurers are levying surcharges averaging $50 to $60 total over 2 years on every homeowner's policy to cover this assessment. If you pay $2,000 annually for homeowners insurance through a standard carrier, you're now paying an additional $25 to $30 per year for the next 2 years just to bail out the FAIR Plan. This assessment is the first of many. Enrollment in the FAIR Plan has more than doubled in the last 2 years, reaching over 640,000 policies in force as of 2025. That's a 115% increase since 2021. The plan was never built to handle this volume. Its reserves are inadequate, and every time it runs out of money, it hits every California homeowner with an assessment fee. And here's the kicker. As climate-driven events increase in frequency and severity, the FAIR Plan will face repeated shortfalls. Each shortfall triggers another assessment. Each assessment raises the cost of homeownership for everyone in California, functioning as an invisible property tax that increases without voter approval and without any cap on how high it can go. But the financial bleeding doesn't stop with surcharges. What's happening in number 1 is the real killer.
Number 1. The hidden property tax. How insurance collapse destroys your home equity. The insurance crisis in California isn't just about difficulty finding coverage or paying higher premiums. It's functioning as an invisible property tax that's destroying home equity across the state. This is the hidden killer. Property taxes in California are capped by Proposition 103, which limits annual increases to 2% unless the property is sold. Homeowners understand this tax and budget for it, but insurance costs aren't capped. When your premium doubles or triples because you're forced into the FAIR Plan, that increase functions economically as a property tax hike. Unlike a voted tax increase, there's no public debate, no ballot measure, and no cap on how high it can go. Let's do the math on what this means for your wealth. If you own an $800,000 home in California and your insurance premium increases from $1,500 annually to $4,000 annually because your carrier exits, that's an additional $2,500 per year. Over a 30-year mortgage, that's $75,000 in additional insurance costs compared to what you expected to pay. But the wealth destruction doesn't stop with premium increases. The insurance crisis is directly causing property values to decline in affected areas. Pacific Palisades is the perfect case study. In 2023, State Farm canceled thousands of policies in the area. The immediate result? Median sale prices in Pacific Palisades dropped 16% in the following months. If you owned a $2.5 million home in Pacific Palisades before State Farm's cancellations, that home is now worth approximately $2.1 million. You just lost $400,000 in home equity without changing a single thing about your property. No damage, no deterioration, just an insurance company deciding your area is too risky to cover at regulated rates. When buyers realize they'll face $6,000 to $8,000 annual FAIR Plan coverage instead of $2,500 to $3,500 with a standard carrier, they adjust their purchase offers downward. If insurance costs are $3,000 higher annually than expected, and buyers use a 5% capitalization rate to calculate property value impact, that's a $60,000 reduction in what they're willing to pay for your home. Combine the premium increase and the property value decline, and you're looking at total wealth destruction in the 6 figures for many California homeowners. If your property value drops $60,000 and you pay an extra $75,000 in insurance over 30 years, that's $135,000 in lost wealth. For families where their home represents 60 to 80% of their net worth, that's catastrophic. Tell that to the couple in their 60s who plan to downsize and use their home equity to fund retirement. They bought their home for $350,000 20 years ago. It appreciated to $850,000. They planned to sell and live off the equity. But when they list the property, buyers balk at the insurance costs. Comparable sales in the area have dropped 15%. Their home appraises at $720,000. After realtor fees and closing costs, they net about $650,000. Subtract the remaining mortgage balance of $180,000, and they walk away with $470,000 instead of the $500,000 they expected. That $30,000 shortfall might be the difference between a comfortable retirement and working another 5 years. But here's the reality of this hidden tax. Property taxes are visible, predictable, and politically accountable, but insurance costs are determined by private market forces operating under a regulatory structure that's failing. There's no ballot measure to vote on. There's no elected official directly responsible. Homeowners are trapped in a system where costs are spiraling upward with no democratic mechanism to stop it. And here's what nobody's telling you. This hidden tax disproportionately hits middle-class families. Wealthy homeowners can absorb a $3,000 annual insurance increase without changing their lifestyle. But for families earning California's median income of $84,000, an extra $3,000 annually represents 3.5% of their pre-tax income. That's the difference between saving for retirement and living paycheck to paycheck. The insurance crisis is forcing middle-class families out of homeownership in California through a slow financial bleed that makes maintaining a home unaffordable.
The families who built California's communities are being priced out by a hidden tax that compounds annually and shows no sign of stabilizing. So there you have it. California's insurance market isn't experiencing temporary turbulence. It's in a death spiral where Allstate exits statewide, 4 major carriers pull back simultaneously, State Farm cancels 72,000 policies, 2.8 million non-renewals hit homeowners with massive premium increases, and the FAIR Plan imposes billion-dollar bailout fees while property values crash across affected areas. But this isn't just about insurance. This is a systematic transfer of risk and cost from private companies to individual families, operating as a hidden tax that compounds annually with no upper limit. The forces driving this crisis are accelerating. Wildfires are becoming more frequent and severe. Reinsurance costs continue to climb. Construction inflation shows no signs of reverting. And California's regulatory structure remains fundamentally unchanged. So what should you do if you're a California homeowner? First, assess your actual insurance situation now. Get quotes from multiple carriers to understand what coverage will actually cost if you're forced to switch. Budget for a potential doubling or tripling of your current premium so you're not blindsided when your carrier exits. Second, evaluate your fire risk objectively. If you're in a high-risk area and insurance costs are already approaching 1 to 2% of your home's value annually, calculate what that means for your long-term financial picture. Compare the total cost of homeownership, including insurance, to what you could achieve by selling and moving to a lower-risk area. Third, push for regulatory reform. Contact your state representatives and the insurance commissioner. Demand changes to Proposition 103 that allow insurers to price risk more accurately while maintaining consumer protections. The current system is failing, and only political pressure will force change. If you're a potential buyer considering California real estate, understand the insurance crisis is a permanent feature of the market until regulatory structures change. The deal you're evaluating today comes with insurance costs that will rise substantially over the life of your mortgage. What you can afford today might become unaffordable in 5 years when your carrier exits and you're forced into the FAIR Plan. The regulatory system in California pushed insurers out, leaving you to fund the bailout and shoulder the risk through the broken FAIR Plan. This isn't just an insurance crisis. It's a silent devaluation of your single biggest asset, your home. The only way to protect yourself is to stay informed.